In this session, we're going to look at emerging markets, their recent performance, and some of the key macro and valuation indicators used to look at emerging markets. But first, a bit of a recap on emerging market performance, both over the medium term, but also more recent history. So if we're looking at performance of emerging markets since the end of 2010, they've underperformed global equities by a significant margin. As we can see here, global equities is the gold, so that's basically doubled over that period. The blue line is emerging markets in Australian dollars and the red line is the ASX 200. These are just in price terms, so a significant underperformance over that period of time. If we just now turn to some of the key drivers over that period, and if we add, for example, I'm just going to add a CRB metals price index as a bit of a proxy for commodity prices. So if we have a look at that, you can see that broadly through the period from about 2011, commodity prices were turning down and then had a particular hard fall during 2014, 2015. So that was clearly a negative. In more recent times, over the past year and a half or so, we well know that commodity prices have risen. So commodity prices were a key contributor behind the underperformance of emerging markets and have since also been a positive contributor. Stepping forward from there, if we have a look at actual growth in emerging economies in general, what we find is that emerging market industrial production growth has declined from rates around about 5.5% back in 2012, reaching the low after quite a fall away during 2015, reaching a low of about 2.5% at the end of 2015, and it's since picked up, as you can see, rising up towards 4% or thereabouts. So still quite low by historical comparisons, but certainly an improvement in the trajectory, and that has helped the turnaround in emerging markets in recent times. Now, we can also look at earnings revisions, and in this particular one, I'm going to look at earnings revision ratio. If we take a moving average of that one, just to smooth it out. And here, what we see is this is the earnings revision ratio for emerging markets on the green line on the right hand panel, so sort of in negative territory. That's positive up here, and it's only reached positive really for the first time since 2010, so we're seeing an upward revision to earnings as well. So if we look at more recent history, we'll just have a look, say from 2015. You can see that emerging markets on the top panel there, the blue line, have outperformed by quite a handy margin over both global equities and also domestic equities. So just going back now to 2010. So what else has gone right for the asset class? Well, there's a few things. We already talked about industrial production growth across the region, and indeed a lot of that improvement has occurred in Brazil, where it's gone from growth of, well, a contraction of about minus 12%, turned around to slightly positive industrial production growth, so that's a significant turnaround. China, the red line, we've seen some stability and a bit of a pickup in industrial production. Also in Korea, we've seen somewhat of a pickup, and not a lot, but sort of stabilization in India and Russia. So certainly the big driver has been the major turnaround in Brazil from a severe contraction to slightly positive growth, and also the improvement in China. Elsewhere, though, there have been other improvements for emerging markets. Current account deficits have narrowed. In this particular chart, this web chart, we're looking at the blue lines representing the current account position for some of the major emerging economies, and the red line shows where those measures were 3 years ago, so going back to sort of 2013-14. So if the line is towards the outer perimeter of that particular chart, it means a current account balance, and if it's in close, it's a large current account deficit. So deficits have narrowed, turning closer towards surpluses in most regions over the past 3 years. Now that's partly a function of a decline in demand, There's also partly an improvement in exports. Other areas that have shown improvement, key macro drivers, cash rates. Cash rates have also moved broadly in the right direction, with their currencies no longer under pressure, inflation falling away a little bit. They've been able to respond to the slowdown in demand and ease interest rates in a number of these countries, except for probably South Africa. But basically, you can see here the pink line on this occasion is 2 years ago. The blue line shows where cash rates are now. And so essentially they've been declining pretty much in all the regions, not by a lot, but certainly moving in an easier direction. Now, turning to profit margins and return on equity. So certainly profit margins have picked up in EM, probably more aggressively than they have in the developed world. You can see the red line is emerging markets. Profit margins have become quite low. The downturn in demand, higher wages costs, and so on. That has since turned around. So profit margins picking up quite sharply. And we've seen a reasonable ongoing improvement in global profit margins. And finally, return on equity. We can see there too, the purple line is EM, return on equity. This is IBIS data. That's also improved quite sharply compared to that of global equity market. So a number of these factors have turned in a more favourable direction over the past 12 months. Of course, one of the risk factors for emerging markets is the strengthening US dollar. And that was certainly a factor during 2011 through to 2015, 2016, particularly in 15 and 16. The green line here, right-hand scale, shows the US dollar broad index. So a very strong US dollar was also a factor, particularly when current accounts were still quite large. So created a lot of pressure on the currencies of emerging markets. And the relationship over the long term has been that emerging markets have tended to underperform global equities during periods of strengthening US dollar, and this is shown out in the strong negative correlation that we've seen over time. So what is interesting, though, is that in the most recent outperformance of emerging markets has actually occurred despite still some reasonable strength in the US dollar. I guess there's a couple of different phases here, but from about mid-part of 2016, when it became apparent that both the US economy was starting to pick up and that the Fed was more likely to be lifting rates sooner rather than later, the US dollar enjoyed quite a strong rally. And then following the Trump election victory, we had further strength on the belief that activity would be stronger and the Fed would be tighter still. That had a temporary setback for emerging markets, as we can see up here, the blue line, but essentially it's been able to withstand a stronger US dollar. More recently, the weakness in the US dollar has also provided a positive benefit for emerging markets. What about valuations? So if we look at actually let's get this particular one here. If we look at the valuation on emerging markets, both in absolute terms and relative to global equities, the gold line shows the actual PE. As you can see here, the PE is up around about its long-term average of around about 12, a little bit over 12 times. And the red line on the right-hand scale shows the PE relative to the global equity PE. So it's below the average, over the past 25 years, about a 25% discount to the market. The average discount is probably closer to 20. So it's not massively cheap, but certainly towards the lower end of the band that we've seen, say, since 2005. On a on a sector-adjusted basis, once again, it does appear to be cheap, although maybe not as cheap on a sort of headline basis. So although the emerging markets are not outstandingly cheap, neither could one say that they are expensive at this particular point. So clearly one of the major factors for emerging market performance is the strength or otherwise in the global economy or the growth momentum. So what we're doing here, we're looking at industrial production globally, 12-month change, and we're looking at the sensitivity of the earnings growth, forward earnings growth expectations for each of the major regions. And what we find, if we rank them by the beta or the coefficient, the relationship to industrial production, global industrial production, Japan ranks the highest with a beta of about 5.9, but emerging markets are certainly up there with US small caps, but also Asia and emerging markets you can see there. So it does tend to be one of the more sensitive regions in relation to global industrial production, as one might expect. Indeed, if we look at periods where global growth momentum is above zero and rising, so the economy showing a very early sign of picking up, we find that the performance of emerging markets has been quite strong. So during those phases, above zero and rising, emerging markets have returned an average of 8.25% versus minus 1.17% on the other 72% of the time. So it has been a strong phase. What we've seen just recently, however, is a little bit of a slowdown in G3 momentum. So let's just have a look at that, and that comes up here. As we can see, the blue line is our measure of G3 momentum and includes the US ISM, the German IFO and Japanese PMI. And that has typically been provided a bit of a lead indicator on turns in the global industrial production cycle. So if we look at more recent history, the downturn or the peak in G3 momentum occurred in around 2013 or 2012, 2013 was an early signal that the global cycle was turning lower again, and likewise it started to trough during 15, 16. Now, it can be a volatile series, and it has taken a bit of a turn down. It's still positive, so it's still suggesting that global industrial production will continue to rise in an annual sense from here, but it does provide a little bit of a warning signal. The drop in the most recent number is partly a base effect, but also reflects the downturn that we saw in the US ISM over the past couple of months. So it just highlights a little bit of caution, but essentially it's still the overall growth momentum indicator is still suggesting positive momentum for the backdrop for emerging markets. Thank you.